Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, February the 5th, 2025. This will be a quick and brief review because honestly, there's nothing else to say than the forecast is still on track. Our forecast is for higher prices in a larger fifth wave of a larger fifth wave, which could also be the top of a larger third wave to be determined. If that is the case, though, that's really started to grow on us if you've seen the previous webcast. And as you know, we are using the Elliott wave, and we believe that we are currently in here, potentially in there, but the next pullback will not be a doozy. That's pretty much the message here, but I don't think we need to worry about it. We have zero signs that a bear market is underway. We already discussed that in Friday's webcast, and so far we've been proven right. Our forecast for this wave 3/C being underway has still not been invalidated by the market. Remember, we always say we're wrong till proven right, and that is just the case because we cannot forecast everything and predict everything. We cannot predict the future, okay? So all we can go by are these type of well-known patterns that we then apply to the current price action, and then we use price levels to see if we break above or below certain key levels that will tell us that price pattern has been invalidated, there will be no continuous upside, or if it's a bear market, continuous downside. Bear markets can last for minutes or for years, depending on your trading time frame. Okay. And we always use the scientific approach as we do in the medical healthcare. I hope people do it. You assess the patient's needs. You know, is he sick? Is he not sick? Headache. All right. Well, let's subscribe some Tylenol, and we'll do 2 tablets per day. And then you check afterwards if the patient still has a headache, yes or no. You monitor, right? The patient comes back, I still have a headache. You can either say, all right, we'll increase the dose, or we're going to prescribe something else. And if it still doesn't work, eventually, you know, maybe you have to do a MRI to see if, unfortunately, maybe something worse is going on, like a tumor, which could be an analog to, of course, a bear market. Okay, that's how you simply assess the markets as well. Nothing else. It's all just probabilities. And remember, that's why we have stops in place, because we don't know if we just have a headache or if we have a tumor. That's why we have the stops in place. I don't know it. Nobody knows it. But we know that if we go below certain price levels in a bull market, that bull, be it a third wave, be it a larger fifth wave, be it a primary 5 wave, is over. Okay, that's what we use. And the stops are always there to make sure that your losses will be minimal, because once you go down the rabbit hole, it will be very difficult to gain it all back. Just cut your losses short and make sure you take profits on the way up, and always raise your stops. All right. And if you still have problems with that, I can highly recommend our ETF Trade Alerts. It will teach you really how to buy, how to sell, how to hold, how to raise your stops, take partial profits all along the way. Okay. Last year we had a fantastic year. I think this year will be fine as well. And of course, you can also trade the Magnificent Seven, the Apples, the Googles, the Microsofts, all that good stuff. Very fun to do, in my humble opinion, very easy, especially for if you're new to trading or just want to try something else in addition to what you're already doing. You know, it just a change of spice makes hungry, right? And let's go straight to the charts. This is our preferred wave count using the NASDAQ, using simple closing prices, because closing prices are the most important price of the day. All right. I don't care if the NASDAQ goes to 0 and then at the end of the day closes at 20,000. 20,000 is what will show up on the chart. 20,000 is what the simple moving averages are based on. Indicators, everything. Okay. That's why we placed, for example, this wave CB label at this week's low, because intraday, it went below this A wave low, but not here. We'll label it as such. It's fine. You know, kind of have to know what you're doing. But otherwise, we're still in this uptrend channel. Yes, we're kind of messing around with this lower slope. So the bulls are, of course, not out of the woods just yet. So we can still see a protracted wave 4. Okay, we need to start making new all-time highs to make this completely, of course, redundant, and a break above 20,000 to 20,100, this B wave high, will suffice to let us know this wave 5 is underway. Will let us know, meaning it's in the books, we can sign off on it. Not just yet on this index. And every index is in its own world, okay? Of course, they're bigger picture-wise aligned, but daily, weekly, sometimes monthly can be huge variations. This is the NASDAQ 100 daily chart. I've been sharing this with you over the last couple of days. Not my preferred chart, and you can see how horrendously choppy it has been since pretty much the top here in mid-December. So we've now had almost 2 months of nasty mess. All right, this is just sideways consolidation. This looks really messy. This does therefore look corrective to me, and therefore we should expect higher prices. I mean, first glance, this is like not a impulse lower in any form or fashion. All I've done here is raised the warning levels for the bulls, the first, the second, and the third, and the fourth one remains the same, which is the January 13th low. As long as that low holds, we prefer to look higher, okay? I have no green 3C targets on the hourly chart. I'm just raising the stops or the warning levels, okay? Which can be used as stops if so desired. The upside targets are on the daily chart. We want to see a break above, of course, the B wave high made last Friday to confirm the wave 3/C, which should target anywhere between 22,400 to 23,280, depending on what type of extension we're going to see. 1 equals 3 or A equals C. I don't know yet. So we have a very large target zone. And then we're going to wonder if we're going to see a 4 and a 5. Okay, if we get into the ideal red target zone at 22,826, 23,397, somewhere thereabouts, things start to, of course, already look pretty toppy. That's the ideal target zone. We don't know yet if it's going to exceed or be lower, but I think we're going to get there one way or another. And the last 3 days look bullish. Today looks bullish. I mean, it's a higher prices. In bear markets, price goes down. In bull markets, price goes up. So far, we've gone up 3 days in a row. Okay, meaning, yes, on Monday, we were lower than Friday, but you see where we opened and you see where we closed. As such, we've raised the warning levels. We're back above the Ichimoku cloud. We're back above the 10, the 20, and the 50, the 200-day, yada, 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 yawn. All I can say is this still looks good. We're in a uptrend. This is the trend channel. And, you know, I'm really regurgitating and beating a dead horse, but so far so good. And the warning levels will tell us, you know what? No, we're wrong. And below 21,008, which is Monday's low, really increases the odds that this wave 4 will subdivide further in time and space, as I showed you for the NASDAQ 100. That is our alternative wave count now. Very simple. It is our insurance policy. Trade the preferred wave count, which is higher. All right. So far on Monday, I bought the dip. That worked. Yesterday, I bought the dip. That worked, which is pretty much the open. Today, I bought the dip. That worked. That's what happens in the bull market, right? In bear markets, you sell the rip. Quite different. So far, so good. But price is the final arbiter, and below 21,405, which is today's low, starts to increase the odds that, watch out, we might still extend in this red wave 4. It's not preferred, just so you know, that will be the case if that happens. Same for the S&P 500. All we did today, raise the warning levels on the hourly chart. The S&P 500 already made a new all-time high, not the NASDAQ 100. So this one suggests that we are indeed in this green 3C. That should target anywhere between 6,285 to about 64.90. All right. Again, depends on what extension we're going to see. The rally from the September low into the December high was 3 waves. So we should expect 3 waves as well. And you can see the green 3C target zone matches very nicely with the red wave 5 of 5 target zone. Alternatively, that's only 3. We've raised the warning levels, which is a bullish occurrence. If you raise the warning levels for the bulls, it means price goes higher, and that's what we're doing. So far, so good. 60.20, 59.95, 59.23, Monday's low, and ultimately 57.73. And that's the line in the sand for the bulls and the bears. Look at the uptrend we're in. We're back above the 10, the 20, the 50, 200-day, yada, yada, yada. I mean, this is just bullish. Bullish until proven otherwise. and which I would say is pretty much Monday's low. That's really a firmer line in the sand, with the ultimate line in the sand, again, January 13th. Dow Jones, did we already bottom for this wave 2B in potentially a irregular expanded flat that barely did a 23.6% retrace? Very possible. I would like to see a more protracted wave 2/B. Why? Because the wave 1 took a couple of weeks, and then the wave 2B would be nice to have some more time to it as well, so to say. But beggars can't be choosers, so that's the question mark. Otherwise, I think longer term, we're still looking higher. IWM, all right, this one starts to really grow on me. I haven't shared this with you in a while, but again, the last 3 days start to look really good. On Monday, we bottomed almost exactly at the 61.8% retrace of the rally of the January 13th low. It does look impulsive, and that wave 1 should actually be moved a little bit towards the left. Interestingly, the small caps start to look more and more like the Dow Jones. And then we had a irregular expanded flat wave 2, ABC. Let me add that label to the chart as well. We're going to get a gray A, okay? And this is then A. Then we have the gray B right there. That's the gray B. And then, of course, Monday's low was wave C. And I would say, any long position that is going to get opened should hold against Monday's low, which is about 220. And for the IWM. And we look for a upside target, ideally of 253. It's been on the chart for a long time. For those that have been with me for a long time, that's the ideal upside target for wave 3. And so that means at current levels, you have about almost $30 upside reward and about $9 to $10 downside risk. So this is 3-to-1. That's pretty decent. So this is 1, then this is 2, an A, a B, and a C. And of course, if we break above the recent highs here, I'm pretty certain this wave 3 is underway. And if that's the case, I've done the Fibonacci standard impulse pattern. Wave 3 to about 246.5. Wave 4 ideally down to about 236.6. And a 5-1 relationship targets 253.05. Very close to this one. Note also here how close the wave 3 got to the ideal 138.20% extension. So this starts to really grow on me. All we need to do is pretty much go back above this 230 level, and we're off to the races, in my humble opinion. This is a good looking chart. I like it. Well-defined risk, well-defined reward. Again, risk means it's not a guarantee, okay? That's the difference. And that's really always something we need to take into consideration. And you can always add to a winning trade, okay? If it finally starts working your way, start adding to it. That's a much better strategy than buying lower and lower, hoping that it eventually will go back up. Most of the time it won't, because it's going lower and lower, right? Then you're not trading the trend that you want to have, but you're trading what you don't want to have. All right, slight difference. So I always argue against averaging down. Last but not least, the semiconductors still don't like this index. I can't make much soup out of this. We're still below the 200-day moving average. Great if it still goes all the way to 5,700. Maybe it wants to fill this massive gap, of course, due to the DeepSeek's fake, whatever that was, app at 5,350. All nice and dandy. I have very low confidence in what this wave count is. So I'm not going to touch it and cover it much going forward. I still think we've topped for a much larger top. I mean, the S&P 500 is right up here, right? At 5935 equivalent. And look where we are. It's like the Ethereum versus the Bitcoin. All right, let's look at some market breadth indicators to tell us, is the bear market around the corner? No, we made just a new uptrend high in the AD line, okay? So breadth often leads the price. And we have now a new uptrend high, not a new all-time high yet, but a new uptrend high. So this suggests higher prices. See, this high here is above this high here. So meanwhile, price is just slightly below it. So this is bullish. Why is there no bear market yet? I've shared this many times before, but it's never hurts to repeat it. We need years, at the most months of negative divergence in this accumulative AD line to tell us that a massive bear market is going to happen. We saw it in '07. We saw it in around 99 to 2000. It took almost 10 years here in the 50s and 60s. And of course, it took about 2-3 years in the 1920s to usher in, of course, the dreaded 1930s crash, to usher in here, as you can see, this sideways pattern, which is a primary four-wave, where we saw 1 to about 50% declines in rapid succession. So this is, of course, not a very bullish environment that we had here in the 60s and 70s. And then, of course, we got the tech bubble bursting, and here, of course, we had the subprime mortgage crisis. Subprime, it's not subprime, subprime. So we have no negative divergence on these monthly timeframes. So very simple, no bear market. Okay, that's it. Why? Because we have 1, 2, 3, 4 points of data, and that's what the history shows. So all we can expect is that the future will do the same. No guarantees, but yes, all you can go by. If all you have in the past is progress with occasional hiccups in place, we must expect progress going forward as well. There's no data point to tell us there will be no progress. Oh, will there be sucky years and sucky decades? Yes, we can see that. Of course, the 30s, the 40s, the World Wars, horrible, horrendous time for humanity. But look where we are now versus 300 years ago. That's what I mean. I don't want to just brush over those horrendous global events. But the point is that if your data points show that nothing but progress with these hiccups in between, then we must expect, in the same case here, a bear market only on large negative divergence in the AD line. We're not seeing it, so therefore we must conclude there will be no bear market. There are sometimes 25% corrections in between without any negative divergence, okay? So it doesn't preclude down markets, not at all. Just the difference that a bear market is, of course, a multi-year decline versus a multi-month decline. All right, enough about that. The PMO buy-all, sell-all indicator is stalling out at 86. So we could have, again, just a fake sell signal, and we're pretty much going to be back into a buy signal. How we're doing for the intermediate term indicator, it's still on the buy. It's still above the dotted line. So this one is also supportive of higher prices. The actual reading here is at 38884, and the dotted line is at 3877. So far, so good. So that is positive. The uptrend continues. That's also, of course, a added positive for the bulls. How we're doing on Market Brev today, the McClellan oscillator was at 18. So we have more advancing stock than declining stocks. That's bullish. As such, the summation index remains on a buy. Very good. So this chart is bullish. This chart is bullish. This chart is bullish. This chart is neutral to bearish. This chart is bullish. This chart is bullish, etc. So I guess the weight of the evidence is bullish, but price is the final arbiter, and therefore we have our stops in place. Regardless, our preferred wave count remains the same. Higher prices in either a ABC or a 3-4-5 pattern. Semiconductors is still the ugly duck out there, the black sheep, you name it. We don't like it much. We do like the NASDAQ 100. We do like the S&P 500. We do like the Dow Jones, and we now also really like the small caps. That starts to look really good, especially with a IWM above 230. So this is what we have. We remain bullish, I would say cautiously bullish, maybe 80% bullish, so to say, whatever number you want to put on it. But that's better than being full-on bearish. And I hope that keeps you on the right side of the trade. Take care, trade safe. We'll catch you all later this week.